Hello, everybody. Brian here. Let me know if you can hear me okay. We are now online. Yay. All right. Just checking on stuff to make sure everything's okay. I'll be recording this as a podcast as well. All right. So we are ready to go. Um, Let me pull up my trusty chart here and let me know if you are online and let's have some fun with it. So, I need to make sure people kind of understand where everything's at with TradingView. Bitcoin USD is easily the number one asset out there. So number two, I'd say, is either oil or gold. So I'll leave gold up for now. This is XAU. We're using FX Open, which is fairly new. There's also Wind as well. So I'll just leave it at that. So we'll use Bitcoin. And there you go. So I wanted to show the better which one's getting the better return. So far you can see that um, gold is rarely beating. Uh, um, sorry, gold is beating out the U.S. dollar here. So sorry, so that's Bitcoin right there. So it's all negative. Yeah, Bitcoin's having a not a good day today. Let's take a look at a couple other ones. So we have here, there's gold, Bitcoin. I'll put in DXY as a currency for the US dollar. And we'll put in the Yuan. So why don't we do the Awanda one, USD CANH. So we'll use Awanda for that. So here you go. So those are your comparisons right there, intraday only for our chart. Or how far back does this go? Wow, this goes back quite a bit. So that's going back to the beginning of May. Hmm, interesting. Well, let's go year to date. So we're 6 months here. So you can see here, Bitcoin is definitely the winner here. Let me just repeat and rinse here. All right, so we've got everything set up here, as you can see. Um, so we got Bitcoin, gold, USD, XAU, USD, as well as USD, China, Yuan, and DXY. So you're looking at a chart year to date. So I'm recording this as a podcast as well. So it'll be only an audio version. So we're looking at Bitcoin up 54%, gold up 7.59%, China, Yuan. And again, that's USD, China Yuan. So that's the flip of it is 2.74. So that's a weakening China Yuan. And the DXY, which is the dollar index, at 0.48%. So you can clearly see here the winner is so far for the year, it's by a long shot, is Bitcoin. But when you go to, let's say, a month, things change. So now you're seeing Bitcoin at the bottom there at negative 12, gold at negative 2.7, and now both the DXY 2.6, 2.86. So this is now the turning of the tide, where DXY, US dollar, and the China Yuan is uh, getting stronger. Now, again, remember that's USD China Yuan. So that's a weakening Chinese Yuan against the US dollar. So the US dollar right now is the dominant one. So we are looking at a 1 month time frame. So if you go to a 5 day, this is where things get really wonky. Bitcoin's still negative. DXY is now negative 0.05. Gold is plus 0.12. And USD China Yuan 0.38%. So you got to ask yourself, this is not about buy and hold anymore. This is not about buy and hold because clearly Bitcoin is negative over the last few uh, month or so. Let's say a couple of weeks. So Bitcoin is not worthwhile holding on to. But the US dollar seems to be, or gold maybe. But if you were to add in, let's say, so that's a 5 minute chart you're looking at there. So if I was to throw in for fun, XPX, which one's the better one? You can see here now that the markets are doing much better with a 2% return with SPX over the last month, I believe. Yeah, or no, no, this is for the last 5 days. Sorry. So if I was to look at just to give you an intraday today, this radically flips again. Bitcoin's up. So you got to ask yourself which one's the better one to hang on to. I'll be looking at the 1 month view, and quite clearly you can see out of everything that the SPX is your best one to hold. But the question is, how long will the SPX last? So this is where it's going to throw you off. We had Apple today release their headset thing. I was really shocked to see this. So when you look at Apple, Apple's stock kind of got crushed. Let me take out one of these. Let me take out Bitcoin. Okay, so we don't want the. So here we have the market tanked today, and you can see gold spiked. Okay, quite a bit. And when you look at, as I was going to compare Apple I thought was going to pop today. I really did. And Apple did move up quite a bit, and it dropped from 7% down to 4.59%. Okay, so this is one of the drawbacks of these big tech if you do intraday. I could also take a look at NVIDIA, which got that big run up. NVIDIA here. So NVIDIA, it's still retained. That's pretty shocking. That's still able to retain its 37% return, and it has not collapsed. I think this will at some point may collapse when the markets turn. So again, when you look at and again, this is intraday. So overall, SPX is up, but NVIDIA is the big winner, obviously. Okay, so let me get rid of that one for NVIDIA. So this is the real question: is what's worthwhile to hold to get maximum return? Because if you look at gold, it's not performing. But let me pull up a new chart here, just as a comparison. So let's say I'm only using XAU USD because these are usually the popular ones that most people look at. I think there are better gold plays out there, but I'm just going to show you the popular ones. So we have XAU USD. Okay, so if I was to show you a monthly view, so here's the monthly view. It's been declining. Why? Because as it should, and if I look up, let's use as SPY, okay, the S&P 500 ETF trust, okay. So this is the typical relationship historically we should see. SPY, or the markets go up, stock market goes up, and gold should come down. That is what we should typically see. But if you look at a 6-month view, you can see that they work together. They're correlated. There's no, up until the last few months, starting here, May 23rd, it started to diverge, as it should. Like that's what when you're in school back in the day, economics 101 would tell you this, that if the markets go up, then yeah, it should go up, and then gold should be uncorrelated and move indirectly against the performance of the market. So it's doing what it should be doing as of May 23rd. So up until that point, the market was really distorted. So that's a good sign that gold is going negative. So as long as the markets tank, gold will perform well. Now, what's my view overall of the stock market? Um, from what I'm seeing, uh, it's really hard to tell you. Like if you look at companies like Apple did fairly well, but it might be better to look at a company like Google or Alphabet, see how they're doing. So they're doing fairly well, or MSFT, Microsoft. And I'm bringing them up because it's important to note that these are your big tech companies. These are the kind of companies that are skewing the markets, right? So majority of stocks are not performing anywhere as close to the big tech. Let's say the top 10 companies, because they're skewing the markets, making the stock market look healthy when it's fundamentally not really strong. We've got weaker manufacturing. We've got all kinds of weakness out there that shouldn't be happening, right? If you got any questions, let me know. But yeah, big tech's what's skewing the stock market in the U.S. and it indirectly skews the overall market globally, right? So I'm going to get rid of these other stocks here. So I just want to mention that you got to realize that the stock market is somewhat skewed, um, and there's a lot of downward pressure in the markets right now. So if you look at a company like, I don't know, GE's been doing okay. General Electric, you can see there it's very volatile, but trending up. Let me get a daily view here. Boom. Okay, we don't want that. We want 1 day. You can see here that yeah, generally General Electric's not doing too good. Or let's see here. How do I get my? Okay, 1 day. There we go. So generally, yeah, GE is doing okay. But you can see here it popped in uh, 23. So it's been doing pretty good actually. So let me try another stock here. Let me try like I don't know IBM. If anyone wants to try, give me a random stock. But generally, the best reliable way to know if how the global markets are doing, like not just stock market but everything. There's XAU, XAG gold silver ratio, which can be fairly reliable. And you can see here it's kind of gone flat, but generally it has inclined, came back down, and then it's gone kind of choppy. But generally, let me pull up a 5 year. So you can see here, it really spiked in 2020 for the global sickness. Did increase during the time of April, during the virus kicking in still, and it's kind of gone choppy here. So generally, if I was to show you all, this is generally what's been going on. Here we are in 2008 level, right? And now we're kind of at that same level historically for the gold silver ratio. And what that says mainly is that the global risk that we were at in terms of fear, we were at the same level as pretty close to and pretty well mean reverting along the peak here, what was in the 2008 period. So that's how much risk we're at, comparatively speaking, going back over the last 15 years. So we're at the same level of risk as this. So it's just now waiting it out to see a catalyst to come in. And this catalyst is this right here, um, with the global sickness when it first popped in. You can see here it was building, and as soon as January rolled around that year, when the global sickness was first out, it just peaked, and then it tapered back off. But here, and then they started pumping all the money from the Federal Reserve, and printer press went burr. And then as they printed more, that global risk started to continue, and it's just been basically mean reverting there. So it's a matter of a calamity waiting to happen to push it back to the same level as what we had before. Now, what will be that catalyst? The way the last 2 days headlines they've been with with uh, war with potentially China and maybe Russia as well. So that's the risk there and what's driving that outside of national debt as well. So that's something to really understand the history of that and where we're at. Okay, so when you compare that to gold, and remember that's a gold silver ratio. So when you look at gold, how's gold doing? You can see there's some kind of relationship there, but it's not. You don't see the equivalent of the extremities as you do with the silver, and look at the gold silver ratio. So gold is somewhat suppressed. One of the indicators that I learned about was because of inflation. Inflation will suppress gold performance unless there's again a major calamity. So when you look at in the last 3 months, you can see here gold silver did not factor in back in March when the bank crisis was really kind of kicking in right here along here, and the gold silver ratio kind of didn't really factor it in, but gold did move up. And when you look at Bitcoin as well, you can see it kind of also moved up and it kind of moved back down. So these are your hedges when things get really, really, really bad. So both gold and Bitcoin. So when that happens, but they only work when there's a major calamity. Okay, and the last major calamity was just that the banking collapses back in March, and the other big one, as I said, was in 2008. So you can see, well, I don't know why. Let me see here if we go back 5 years. So you can see here that the gold silver ratio, but Bitcoin's been very, very volatile. So what's happening right now with in terms of performance? I think we're moving into a world of fiat versus digital, fiat versus crypto. So let me pull up a better. So I'm going to bring up the DXY. Now this is the US dollar index. Okay, so we can do a comparison. Let's say over the last let's say last year. So here's the story. We have, we want to go back maybe 5 years would look better. Yeah, you're not seeing what I want to show. Okay, let me get rid of these two other ones first. I want to show you. So here is the performance of the DXY, right? So the DXY was the best performer probably out there for all assets to hold for last year. Was easily from 90 to 114. You got a 25-point move holding DXY over last year. So if you didn't trade at all and just moved everything in the US dollar, you would have done really well. No trading, just holding DXY or US dollar. You would have done very, very well. And then you can see what's happening now. It's starting to decline. So what does this mean? Is that when you factor this against gold, XAU, USD. Um, and if I pull up a 1 year again, or 5 year, let's see here. So here's the 2022 move for DXY. That's again US dollar. You can see it's inclined. What happened to gold? It declined. So there's all these different scenarios, meaning where they either they correlate or don't or are uncorrelated. You want to build wealth, you have to own uncorrelated assets. So you can clearly see somewhat there is an uncorrelation here between gold and US dollar. So when US dollar is weakening, you can see what's happening is gold goes up and vice versa. So the reason for that is that these are major institutions, especially US based. If the US dollar goes up, they'll dump gold and focus on US dollar holding US dollar, let's just say, if that's the only assets in the world. And then that's a pretty clear correlation somewhat, but then you get time periods like here where both move up together. So majority of the time, there is an uncorrelated relationship between gold and US dollar. Okay. So then if I was to throw in, well, we're focusing on gold. So let's say if I threw in Bitcoin, what would Bitcoin have done? So with Bitcoin, you can see Bitcoin is easily outperforming all of them, right? But the problem here, so even if you go back to 2019, Bitcoin still, by a long shot, outperforms uh, the other two. But this is where the timing comes in. If you get your first wave of profit with Bitcoin up until March 2021, and then it drops back and then it climbs again up to here, November 2021, and since then it's declined. I've done very well in these two runs, really well, but Bitcoin is not the influential as it once was. So, as I said, it's really now moving into the world of fiat, gold, and Bitcoin as the new money system that people are moving towards. I think, let me just pull up, I'll get rid of these two. Just want to show you just general performance of gold, of DXY, US dollar. So the dollar has started to decline. Why? As long here, the US government's weaponized their US dollar against other countries. And that, not only that, but countries have held their debt in US dollar, right? So if their debt's rising, it gets worse for them as they hold debt in US dollars. So that's why a lot of countries are very skeptical of wanting to hold US dollar for debt, to dominate a US dollar. So that's one reason why they want to get rid of it. And they also don't want to hang on to US dollar, because if their country does something wrong, they get penalized by the US government, through sanctions or some form of something. We know those countries, right? Because those countries have to play along with the system if they're going to denominate their debt in US dollar. So that's why we see this big decline here. And that's a fairly big decline from 114 peak all the way down to here. And it goes up and down. But if you see the relationship between that, and again, let's pull up the SPY, right, to see the relationship between the markets, you can see there's somewhat a separate relationship here. It's very subtle, but you can see here as the SPY or the stock market moves up, US dollar should decline. And then as it falls, like in 2022, it moves up. And again, it's kind of starting to show that same relationship for last year. And we're seeing that the SPY is moving up. Meanwhile, the DXY is kind of declining. So that's another driver of that. And that could also be driven by exports. So traditionally, if US dollar gets weaker, exporters in the US market uh, do better because the dollar is cheaper. So if the dollar is cheaper, other countries will order product from the US because the dollar is cheaper, especially if the company is charging product to be charged in US dollars. So here, this makes sense. So the market could go up as more exports rise as the US dollar weakens. That makes sense. That's a typical relationship. That would make sense. Um, so when you throw in good old Bitcoin again, the problem here, it's really hard to say what's the story here, what's the relationship between the stock market, U.S. dollar, and Bitcoin. There's no story here, right? So it's very hard to predict that. Very hard to predict what Bitcoin does. So it's kind of you can kind of see it between the U.S. dollar and the stock market. There's that relationship, and we already know if I throw in gold, um, or XAU, XAU. And again, I'm just showing you the popular ones, so you could see here what's happening. Or should okay. So again, we're looking at the relationship between gold and the stock market, right? You can see somewhat gold moving in the same direction as the stock market. But as I said, that's how it's been for, well, since 2018, right? That shouldn't be happening. But when you look at what's been going on, let's say in the last 3 months, as I said, you start to see that breakdown, that uncorrelated breakdown, that indirect relationship that's supposed to be normal. So that started. What's driving that? Hard to say. Um, but if the markets go down, gold should go up. And that's what we're kind of seeing right now. So if that continues long term, this kind of relationship as it should, then it's much easier to predict the market. But again, when you throw in the U.S. dollar, the DXY, how's DXY doing? So now you've got DXY moving along with gold, which shouldn't be happening either, right? And then you start to see what's going on with Bitcoin, and then you see Bitcoin in the dumper, right, along with the dollar. Because usually I could show you there's a relationship between the dollar. Actually, I can show you now. If I show you the relationship between the dollar and Bitcoin, there was a relationship. So everything what I'm saying is kind of breaking down, but there's other relationships forming. So if I show you DXY, okay, and the relationship between that and Bitcoin, traditionally Bitcoin used to move in the opposite direction of the US dollar. And look what's happening. It's flat, but Bitcoin's been declining, just declining, declining. That shouldn't be happening. And Bitcoin, let me just show, is that the last month? Yeah, so monthly, Bitcoin's been declining 3 month. Yeah, So we're going back to April. But what matters is what's happening in the last month. So Bitcoin's declining. So you see here, as US dollar moves up, Bitcoin moves down. So that relationship's now intact. More extreme for Bitcoin. So another way to predict price movement of Bitcoin's on chain, but theoretically, it would make sense if Bitcoin is reliant on investments from institutions, uh, the U.S. dollar's got to be weaker. Okay, so that makes sense, right? What's happening? Because if the U.S. dollar is up 2.7%, Bitcoin's going to suffer, right? But here's the other catalyst as well, and I showed this before. What happened when the banks, those three banks, went bankrupt in March? Bitcoin spiked along with gold. So right now, if I was to show XAU, gold, and US dollar, what's happening? So the same thing's happening. You can see gold, US dollar performing, gold going down, and Bitcoin getting hit even further. So why is that? And if I throw in the stock market, we'll do the SPY again. What's been happening with the SPY? That's moving up. So this gets kind of weird, doesn't it? But this is how, and I just showed you a period where these two should move in the opposite direction. So, what do you focus on moving forward? Well, people will tell you that they'll focus on uh, gold and Bitcoin. But meanwhile, we have the dollar moving up. And why is the dollar moving up? Simple. When the dollar is moving up because of the US debt deal has just happened. So the dollar, a vote of confidence, has moved the dollar up. Now, how long will that move last? Nobody knows. I wouldn't be surprised. You'll see the DXY start to strengthen for a while, and if they do, gold and Bitcoin won't do so well. So everything's really reliant on the DXY, the dollar, US dollar performance. Now I'm going to throw in the uh, Yuan, USD China Yuan. Now this is, you think it's not showing strength, it's not. And this is not strength, this is weakness on the yen part. Okay, even though it's moving up, that's the dollar moving up as the yuan, Chinese yuan, weakens. Okay, so everything moving forward is about the dollar. What happens to the dollar? And as long as the dollar moves up, this is probably what you'll start to see, because the dollar is king of all, the king of all I don't want to say safety assets or safe assets, but right now, think about this. If you're an institution, as I showed you in 2022, and you know that the dollar is moving up, then that's where you invest, and you have the weakness of gold and Bitcoin. Realistically, over the last, this number, this is after the last month. So if we see the last 5 days, uh, gold has moved up as well, and DXY has gone negative. So this right here, DXY could go negative, but it most likely will continue to move up. And that's all driven by what goes on with the economy of the US. So it's very hard to predict the future, but without a doubt, DXY and the weakness of the Chinese yuan go hand in hand. But between gold and Bitcoin, um, as long as the dollar does well, that's probably where you want to put your cashola. Um, And yeah, it's tough to say even on a daily basis here. Um, gold moves up. So there's a simple trade you could do here. A very simple trade. If you factor out Bitcoin, let me get rid of that because Bitcoin can be a wild factor because of its volatility. Now, if you're not wanting to deal with Bitcoin, this is what you could do. So you could see here, gold has gone up today, DXY's gone negative. So if you want to have a safe trade, let's do it this way. What's happened last month? So so I'm going to get rid of the Yuan. That's kind of, hate to say, meaningless at this point. So you can see your gold negative 3.4, DXY up 2.5, 2.6%. This is the last month, and SPY at 4.4% in the last month. If I look at the, I don't know, let's do a 3-month chart here. DXY seems to be the barometer of which way things go, right? And it's just everything's so distorted right now. Everything's positive, but what you could use, let's say over the last year, or probably year to date might be the better. You can see the dollar's fairly range bound, only moved 0.48%. Meanwhile, gold is up and the markets are down. So if you want to simplify your trading, you can use the DXY as the barometer for which way things go, because you could see here slightly, you could see it as the US dollar weakens. Uh, the markets go up, SPY goes up, and you can sort of see a relationship. Well, it's really hard to tell, but definitely, if I got rid of gold, you can see this relationship that has started to form over the last, it's this year to date. Yeah, this is year to date. That when the US dollar falls, the markets go up. When the dollar strengthens, as in here, the overall the SPY will fall. So there's an indirect relationship there. So you could use the SPY as your barometer to forecast potential moves of the stock market. Generally, if this holds, let's see if it has. So that's a year to date. And does it work? Somewhat. Yeah, it definitely works over the last year. Definitely works kind of over the last 5 years. Now, remember, this is a unique period of time. So when you have the SPY as it did, when the sickness, global sickness kicked in, the markets were flooded with a ton of cash, like in the trillions. So that's what moved the stock market so extremely up between here, May 20 to December 21, right? That's because the markets were flooded with cash from the treasury. So as it dries up, you can see it starts to fall. And that's what's happened. And then institutions started to move towards US dollar, and you can somewhat see that relationship happen again. Okay, so this is the credibility of the US dollar with the de-dollarization, and the markets go up. So that's a fairly safe way to gauge over the last 5 years what's going to move. So if you see the dollar decline, markets could move up and should theoretically move up, or a better word, trend up. And as I said, when you factor in gold, again with gold, USD, you can see how this kind of relationship's kind of there with gold. And right now, gold should not perform with the markets. But the question is, as of like a month ago, that relationship between gold and the stock market, are they going to normalize the way they should and they move and diverge from each other? That's the question. And then when you throw in the Bitcoin, it just, unless you want to hold on to extreme volatility, Bitcoin really messes up these things. So here's my thing: is if you're looking for relationships on what moves and what to use to forecast, your U.S. dollar is the golden bar, standard bar to use as your barometer to forecast what happens to both gold and the markets. So again, if the dollar weakens, the market should go up and vice versa. And gold seems to historically somewhat, you won't get the really good moves of the markets like between here and 21 when the markets moved up. Gold kind of stayed fairly flat, didn't trend up, right? But you can use gold as a safe haven, and the dollar as well. Now, Bitcoin is going to have to be treated separately from all of this because there's really no proven relationship, because it can correlate with the markets and then it may not. And then Bitcoin can correlate around performance of the US dollar. So nobody knows. So Bitcoin has to be traded on its own, and anything crypto related. That's all I can really tell you from what I'm seeing here. The yuan is going to be weak. One, if China was to finally have its economy move, let me pull up another. Let's talk about China itself. See if I can find a decent future. I don't really know a lot about the yuan outside of the CFD. So let's see how the yuan is. There's a bonds ETF, US dollar. Let's see if there's a future for it. Okay, let's try this Matt Burrow. I don't know how accurate this is. Matt Bar of EXE. That's no good. All right. So, okay. So, but what we can look at are two things regarding China. There's the Hang Seng market, which is kind of, we can trade Hong Kong through this index, through the Hang Seng index futures. Okay, HSI. So you can see it's been declining since. Also, let me see if there's another one we can try to capture here. Maybe there's a Shanghai composite. So Shanghai composite. So it doesn't look like there is. I'm sure there. Oh, if I go under all, Shanghai local company. I don't know which one's the popular one. Let's see if there's got to be a Shanghai composite. Is there a fund for it? Okay, well, let's just stick with Hong Kong then. So you can see it's just been declining. So right now, the way it's going with China, Hong Kong, it seems to be not worry about it with the yuan. If you want a steady, easy trade, you can definitely, as I said, do this trade. It's a good trade, but there's no correlation with the U.S. thus far. Predictable, that is. So you can see here since May, April, it's gone from here 6.4 now to 7.12. So again, that's USD CNH. That's a good trade. Still not as good as the euro against the Turkish lira. That's still probably your best trade right now comparatively. You can see here, just China is just 150. So you can see with the euro Turkish lira, you're already at 156% since September of 2021. Meanwhile, you only get a 4% return with the US dollar Chinese yuan. The other one that might be noteworthy is the Japanese yen. Very low volatile trade. And, it's steady somewhat, but you still be up 33%. So if you want to have low spread cost with a decent return, yeah, USD Japanese yen's pretty good. So those are your as the U.S. dollar strengthens, those are two good uh, currencies to have, namely the U.S. dollar, Japanese. That's going to get you a better one. If you want to go extreme, just go with the euro, Turkish lira. So this is the simple way to do it. As I said, the DXY versus the SPY and gold in US dollar as well. That's probably the simplest trade. All right, so that's pretty well it, and we'll leave it at that. Hopefully, you got something out of it. Thanks for watching.